Hey everyone, welcome back to Corporate Decoder, the place where we take a peek behind the curtain of big business and find out if their stories add up. Today we are digging into a report from AI, Infrastructure Acquisition Corp, a company that has been busy getting ready to make a splash. So, what is the big news? Well, this report is all about AI Infrastructure Acquisition Corp, finalizing its initial public offering, or IPO, which is basically when a private company sells shares of its stock to the public for the very first time. Think of it as the company saying hello to a whole new world of investors and letting them buy a piece of the pie. This company, which we'll call AII for short, is what is called a Special Purpose Acquisition Company, or SPAC. These are basically shell companies that are created with the sole purpose of raising money through an IPO to acquire or merge with an existing company. They don't have their own operations yet. They are essentially a vehicle to help another company go public. The main event here happened around early October 2025. This report tells us that their registration statements, which are the official documents you need to file with the US Securities and Exchange Commission, or CC, before you can offer your shares to the public, were declared effective. This means the CC gave them the green light to proceed with their IPO. And they didn't just offer a few shares. IS sold a massive 13.8 million units. Each unit is a package deal, a bit like a combo meal. It includes one Class A ordinary share, which is a regular share of ownership, and one right. This right is pretty interesting. It gives the holder the chance to get a fraction of another Class A ordinary share later on, specifically 1/5 of a share. Imagine buying a pizza and getting a coupon for a little slice of another pizza later. They sold these units at $10 each, raking in a whopping $138 million. That is a lot of money raised in one go. This cash is basically what they use to go out and find a company to merge with or acquire, which is the whole point of a SPAC. To pull off something this big, they needed help. They signed an underwriting agreement with Maxim Group LLC. These underwriters are like the sales team for the IPO. They help set the price, find buyers for the shares, and generally make sure the whole process goes smoothly. They also agreed to buy any shares that don't get sold to the public, taking on some of the risk. Remember those rights we talked about? Well, Odyssey Transfer and Trust Company is the company responsible for managing them. They're the ones who make sure that when the time comes, holders of these rights get their additional fractional shares or whatever the details of the right entail. Then there is the sponsor AII, our sponsor Ltd. This is usually a group that gets the company off the ground and is a major shareholder. They've signed a letter agreement with the company, the officers, and the directors. This is a pretty standard document that lays out certain understandings and commitments. And where does all that IPO money go? It goes into a trust account managed by Odyssey Transfer and Trust Company. This agreement is super important because it ensures that the money raised from the IPO is held safely and can only be used for specific purposes, mainly to complete their business combination or to return to investors if a deal doesn't happen within a certain time frame. On top of the public offering, AIA also did a private placement. This means they sold additional units directly to specific investors without going through the public market. They sold about 269,000 of these units to their sponsor, AIA Sponsor Limited, and another 138,000 units to Maxim Partners LLC, this private sale. Totaling over 400,000 units, brought in another $4 million. These private placement units are pretty much the same as the ones sold in the IPO, but the buyers agreed not to sell them for a while, usually until after the company finds its target business. Holders also get some registration rights, meaning the company will register their shares later, so they can be traded more freely. It is not just about the money though. Companies need people to lead them. In connection with the IPO, II are welcomed 2 new members to their board of directors, Joshua Adler and Peter Stoneberg. They're described as independent directors, which is good because they are not tied to the company's management or major shareholders, so they can offer a more objective perspective. Both have also been appointed to the key committees, the Audit Committee, which oversees financial reporting and internal controls, the Compensation Committee, which handles executive pay, and the Nominating and Corporate Governance Committee, which is responsible for finding and recommending new directors. Mr. Adler will chair the Compensation Committee, and Mr. Stoneberg will chair the Nominating Committee. And to reflect these changes and set the rules for how the company will operate going forward, especially as it looks for a business to combine with, they adopted an amended and restated Memorandum and Articles of Association. Think of this as the company's updated rulebook, officially changing its foundational documents to be ready for its next phase. Now, let's talk about where all that money is. As of the 6th of October, remember that $138 million raised from the IPO and the private placements is sitting in a trust account in the United States. This money is the war chest for AR to find and acquire a target company. The funds are locked up and can only be released under specific conditions. Primarily, it is for completing their business combination. But there are also provisions for shareholders to redeem their shares if they don't T, like the deal or if the company does T find a target within its specified timeframe, which is about 18 months. This gives investors some protection. They also announced this big news with press releases. One announced the pricing of the IPO on the 3rd of October, and another on the 6th of October confirmed the closing of the IPO. This is standard practice, letting the world know about these significant corporate events. Finally, the report includes a lot of exhibits which are the actual documents like the underwriting agreement, the trust agreement, and the amended charter. It also has this interactive data file, which makes it easier for people to access and analyze the financial information. So, what is the big picture here for AI Infrastructure Acquisition Corp? They've successfully completed their IPO, raising a substantial amount of capital. This puts them in a strong position to go out and find a business, likely in the infrastructure space given their name, to merge with, the structure with the trust account, and Wright suggests they are following a pretty typical SPAC playbook. One of the main things to watch is how quickly and how effectively they can find a suitable target. SPACs have a limited time to do this, and if they don't, the money often gets returned to the shareholders. The new directors and committees are in place, ready to guide the company through the process of evaluating and selecting this target company. A key risk, as always with SPACs, is that they might overpay for a target, or that the deal they strike might not be in the best interest of long-term shareholders. The success of AI will hinge on their ability to execute a wise acquisition, and on the performance of that acquired business once it becomes a public entity under their umbrella. They've got the cash, they've got the structure, now they need to find the right partner to grow with. Alright, that is our breakdown of AI's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.